delete the margins for nothing. So it's all good on my side. Okay, now again, as Katie said today, we're going to talk about retirement. Now, as you will see from the handouts that you have, and we're talking about the vehicles. Now, we already talked about throughout this workshop about bonds and mutual funds and stocks and all these different kinds that you can actually invest in. So I'm not gonna spend time on that. I'm just gonna give you a general idea of what's out there. There's two things. There's my usual disclaimer that I'm not an investment advisor or broker-dealer. So whatever I tell you is my opinion. I'm not trying to sell you anything. And second, I'm not a CPA and I'm not a tax attorney. So what I'm telling you that because a lot of the things that when it comes to retirement have to do with taxes and have to do with all kinds of different tax strategies that you have. It's always good to do something that's called estate planning on top of retirement planning. But if you have any questions about that, I'm sorry to tell you that I do not have a lot of knowledge about estate planning. So I would have to refer you or to somebody else, and I'll talk to Katie. Maybe we can have a program just on estate planning, not with me, but with somebody who actually knows what they're talking about, and that might be helpful to everybody. Now, if you wanna retire comfortably, you have to invest early, regularly. Use all the tax shelters that you can find, and diversify. Don't want to have it all in one basket. Generally, there's a rule of thumb that you need about 70% of your pre-retirement annual salary to live comfortably after retirement. That is if you have paid off your mortgage and are in good health. If that's not the case, you might want to add another 10% to that. So you might want to add another 10%, so 80% of your annual salary you should have in retirement in order to maintain the lifestyle in retirement that you had pre-retirement. Now that's the amount of money that you're going to need. You might be able to live off less than that, obviously, but you might have to make some sacrifice. You don't just want to continue on your lifestyle that you had before with just having to go to work every day. You're going to need to have about 70 to 80% of your pre-retirement salary. That's as of right now. Where this is coming from, meaning where's the money that I have in retirement come from? There's obviously different sources, and we'll talk about these different kind of sources that are available to you. Just to give you an idea. And I mentioned that early in the program too, how important it is to invest and how quickly your money can grow or does not grow, depending on how much you invest and when you start doing it. If you just look at this, as you can see, obviously the more you can earn in your investment, the more money you're going to make, but also the earlier you start. If you just look at the very bottom of the two bottom rows. The difference between starting investing at 25 and 30, depending on the return, can be anywhere between $50,000 and $300,000 in the amount of money that you have. That's just 5 years. Where you say, well, I'm only 25, I'm not going to have to retire anytime soon. I still have time. That's what happens. That's a lot of money. And again, that's the same amount of money that you invest. You're just starting 5 years earlier, and it makes a huge difference if you invest. And that's only $2,000 a year, which that's just a little bit. That's like $180, $150 a month. That's really not that much. If you have $5,000 a year, you obviously a little bit over $400 a month that you put aside. As a rule of thumb, it should be at least 10%. You should put in at least 10% of your money aside in some sort of private retirement, whatever it might be. We talk about these different kinds, but it should be at least 10% of your money that you put aside every month to not being rushed, to not finding out 5 years before you plan to retire that you actually don't have enough, and then you're going to play catch up, and that's very, very difficult to do. But if you continue to do that, I always tell when I give these personal finance workshops, anybody can be a millionaire by the time they retire. Anybody. Doesn't matter how much money you make while you're working. It's a matter of how much money you put aside and how regularly you do it and how early you start. If you put aside 10% of your money from the first day you work, from the first salary that you draw, to the time you retire, doesn't matter how much money you make, you will be a millionaire by the time you retire. Now, how much that $1 million actually going to buy you 40 years after you start doing that's a different story. We're lucky enough that we live in a country where inflation is not particularly high, so the purchasing power of our money remains intact a lot more than in other countries. But as you can see, it's very important to start early, and obviously the more money you are able to put aside, the more money you're going to have. Now, another very important assumption of that is that you're not going to touch it any time before you withdraw it. Now, the beauty of some of the retirement products that are retirement saving products that we're going to talk about is that you are not allowed to touch it, or you're going to have to pay a penalty. However, if you put money aside on your own, just privately, in a mutual fund or something, there's no restriction on you taking it out. And you got to be very, very careful about it. If you take some of that money out, that will set you back years, depending on how much it is. Can you say you might have already saved for 10 years and you say, I really want to buy this, or I need some extra money to build a home, and you can actually make IRA, you can withdraw money from your IRA accounts penalty free to buy a home. But that comes as a steep price. There is no penalty there in terms of the IRS penalizing you for taking the money out, but there's a penalty on you in terms of that money, and multiples of it are going to be lost towards your retirement when you actually need that money, or are banking on that money 30 years or 25 years down the road. So every time you take money out of any kind of money that you put aside for retirement, that is going to hurt you. And it's going to hurt you more the further away you are from actual retirement. Okay, so the biggest portion of most people's retirement comes from Social Security. It makes up 40 to 50% on average of people's retirement money comes from Social Security. That's an average. Obviously, for some people it's going to be significantly more, for some it's going to be significantly less. Now, the FICA taxes are being withheld from your paycheck. That's how Social Security is paid for. It is 6.2% currently. We're based, because of tax cuts, we're only paying 4.2%. So there's a 2% tax rate reduction because of the cut in FICA taxes. Up to a maximum taxable amount, which I believe it's 113,000 something for 2012. So it was 106,800 last year. They increased it to 130,000. And I would assume, if I had to look into the future, in order to make Social Security affordable and available years in advance, I would assume that this maximal taxable earnings figure is going to go away at some point. That it doesn't matter how much money you pay, it's going to continue. That otherwise, there's no way that this can be financed going forward. It's just very difficult to do. Medicare tax is 1.45% of your employment income. That has not changed. There you go. Now, as you can see, this is not my table. I imported that, but it gives you the requirements to actually be able to draw Social Security benefits. Generally speaking, the average worker has to have worked at least 10 years. You can earn up to 4 credits a year if you're full-time employed, and you need 40 credits to be fully eligible for Social Security benefits by the time you reach retirement age. You can draw as early as 62, but you're not going to get full benefits at 62. And you're eligible for full benefits at 67. I would assume that that's going to change too at some point in the future. So that's the one thing I want to tell, especially for those of you who have 10, 15, 20 years left, so they're eligible for retirement. For myself, I don't expect any of this. I don't expect any of this. I expect the benefits to be different. I expect the age to be the time when you're actually eligible for full benefits to be different. That's all going to change, and that's just pure math. Just looking at it and how much, because people get older and they live longer. When Social Security was enacted, the average life expectancy was a lot lower than it is now, and there haven't been much changes made to that particular system to actually account for just that fact altogether. But these are the different stages. Also, what Social Security gives you, they give you a disability benefit that you get from Social Security. There also is a survivor benefit at Social Security. When you're married and your spouse gets Social Security and you get Social Security, if one of the two passes, the one with the higher benefit, that's the one that continues to be paid. The lower one goes away. That's why it makes sense, if you plan for Social Security, that if both spouses are working, the one that makes the higher income should be working longer. They should work as long as they can, because that increases the way that makes the higher, because the Social Security benefit is based on your salary. So the more money you make, the higher you're going to get. And so the spouse, and also the longer you work, the more you're going to get. So the spouse that makes the higher income should be the one of the two who works longer. Because in the event of a death, the higher of the two benefits is the one that remains as a survivor benefit. So there's some things that you can do, that you can plan for, to make to get the maximum amount of benefit out of Social Security, for example. The minimum age is 62. You're going to get 70% of the benefits if you retire at 62. The full benefits are at 67 if you were born 1960 or later. That's the retirement age if you were born 1960 or later. How much are you going to get depends on how much money you made if you are working during retirement. In other words, if you are working and already drawn Social Security, like if you are drawing Social Security as you could, if you start at 62, you can still work. Your Social Security benefits are going to be reduced because of that. You're not going to even get the 70% of benefits if you still work in addition to drawing Social Security benefits. If you work after you reach full retirement age, there's no reduction in your Social Security anymore. But prior to that, there will be a reduction. There's a very nice calculator, and I'll put that website on there, where, as a matter of fact, you can go in there, and there are different versions of that calculator on there. This is the official website of Social Security. One is where you put your Social Security number in there, and they will tell you exactly what you would be eligible for by the time you retire, which is basically the same as what you get once a year in the mail. Now, once in a year in the mail, you're going to get a summary of all your benefits from Social Security. But you can look that up on that website anytime. You can also, if you're not eligible for Social Security yet for whatever reason, there are there are jobs where you don't necessarily have to pay to Social Security. There are certain states where if you work for the state, you do not have to pay, so you can opt out of Social Security. It's not necessarily a good thing to do, but you can actually opt. Certain states allow you to opt out of Social Security. When I worked at LSU, I would have been allowed to opt out of Social Security. I would not have to pay Social Security. That was a special law in Louisiana. It didn't work wouldn't have been able to do that in New York, for example, where we worked after that, or in Ohio, or in Alabama for that matter. But in Louisiana, for whatever reason, you work for the state, you could opt out of Social Security. Now, obviously, if you do that, you lose all these credits towards your full benefits. Again, this is not necessarily something that you want to do unless you believe that by the time you retire, you're not going to get any money from Social Security anyway, which I don't believe is going to happen. The benefit structure is going to be different, but it's not going to go away. It's one of those things that's not going to go away. It's just not. It's not going to happen. But this is a great tool if you're really interested. Okay, how much money can I expect? And they give it to you in today's dollars and in inflated dollars too. So so what's based on some sort of rate of inflation, what the equivalent is going, because these Social Security benefits are indexed to inflation, so they do increase with inflation on a yearly basis.
Question.
Yes.
The full benefits at 67, it says born 1960 or later. Shouldn't that be 1950? Because I had talked with my attorney a few years ago, and he and I are about the same age, and he was saying we would be getting ours full benefits.
I believe that the full benefits, if you were born before 1960, is a little bit earlier in age. This is what you go to if you go to the Social Security page. That's where this information is coming from. It says 1960. I believe it used to be 65 and they moved it up to 67. Yeah. And that age 67 applies to anybody who was born 1960 or later. Okay. So if you were born before that, you're eligible for the benefits at 65, for full benefits. And again, it is just a matter of time before this is going to move to 70 and to 72, and it is going to move up. Just like what I said before, the 6.2%, that FICA tax is going to go up eventually. It's going to have to go up. They're going to take the minimum out. There's all kinds of different things that they're going to have to do to fund the Social Security. There's just no other way. The money just it's just not there. If you think about it, the system works kind of like the people that work today fund the people that are retired. The problem is if you have more retired people than you have people working, the people that are working are going to have to pay more to fund the people that are retired. That's, at the same time, anybody who pays for the Social Security obviously is entitled to that benefit because you paid for it. It's not that you're given something for free. Anybody who gets Social Security has paid 6.2% of their taxes towards Social Security. So it is not an entitlement where somebody is giving you something for free. You do have to pay to get it. So there are other things where you get them without having to pay anything, but Social Security is not one of them. You do have to pay to get them. Now you might get more than you ever paid for it, or you might get less than you think you should be getting. That's a different story. But everybody who gets Social Security benefits actually had to pay into that particular program. Now, so that's Social Security, a big thing, obviously. But that's there, and everybody takes that for granted. And there's not much you can do about it. You pay your taxes, you file your benefits, and you're done. What's much more important is what you have outside Social Security, because there's so many options to you. And there are two kinds of employer-sponsored programs. I'm going to do employer, and then I'm going to do what you can do on your personally. There are two kinds. Oh, that's great. I can't see. Now you can still see that. Defined contribution versus defined benefit. I have to tell you that most employers are not going to do defined benefit anymore. Defined benefit is going away. Defined benefit is effectively the same as Social Security is a defined benefit program, where you pay in, but regardless of regardless of how the fund does that, where the money is invested, you are guaranteed a certain amount of money based on some mathematical formula. State retirement system, state teacher retirement system in Alabama, and most state retirement systems around the country are still defined benefit systems. But again, you have the same problem. You have a problem where you have a fund of money that's being paid in, that money is being invested, but it has to fund all the retirement benefits of everybody in the system going forward. And so you need to make sure that there's enough money available, because what you get out of that fund is not based on what return on investment the fund has, but how much money you made, how many years you worked, and so on and so forth. Now it depends. In certain states, for example, in order to be allowed to full benefits, you have to be vested. And vested means you have to work for that particular, employer for a certain number of years. Then you're fully vested. You're eligible for the full benefits of that plan. So, for example, in the state of Alabama, it's 30 years. If you're in the state retirement system, if you work for the state 30 years, doesn't matter when you start, but when you work for 30 years, you're fully vested and you can draw. Or if you're over 60, you can draw when you turn 60. In other states, Ohio, for example, is only 25 years. So after 25 years, you're fully vested and you can draw. Now, the nice thing about these defined benefit programs as compared to, for example, Social Security is that if you are fully vested in that plan and you draw from that defined benefit plan, you can still go and work someplace else and get a full salary there and draw the full benefits. Now, it doesn't work if you are in an Alabama state retirement fund and you work for another state agency, you can't do that. You're not going to get it. But if you work for the state and then you go move out of state and work someplace else, you can draw full benefits and then a full salary. That's true for all of these plans. This is not just Alabama. All of these plans, companies used to have them. Large companies used to have, like GM, for example, GE. All these companies used to have these defined benefit programs. They ethically can't afford them anymore. And that's why they're going away. You don't see too many private employers have these anymore because they're very expensive because of the increased life expectancies of the people that draw from these plans. Again, when these plans are set up, or when they were initially set up, we had totally different life expectancies, the actuary calculations that have been done, and that's how these things are calculated. They're calculating the probability of how long somebody is going to live. And based on that, they're figuring out how much money you're going to have to pay in and what your benefits are going to be. So they're going away. Most what you see in companies are defined contribution plans, where the company guarantees a contribution, but not the return on the investment. So in other words, those are these kind of things, the 401k plans. That's that kind of plan where you can make pre-tax contributions, and all of these, by the way, every single one of these plans is based, there are certain income maximums. There are income levels where, and their maximums, how much money can go into these pre-tax and so on and so forth. I didn't put them all out there for once. They change every year. And as I said, I'm not a CPA, I'm not a tax attorney, but they change every year. Every year there are different limits. Now, some of these 401k, these are pre-tax contributions. These are money that comes out of your paycheck before you pay taxes. Now, you could say, I don't want to do it that way, and I make the contributions after tax, and then I claim them on my taxes if I put them in the 401k plan. That's not a very smart thing to do, because it's much better for you to claim the tax benefit right when you get your money and don't wait until you actually file for your income taxes at the end. Because the basic idea is any money that you can get earlier is better. A dollar today is better than a dollar tomorrow. That's the basic logic behind that. So a 401k plan, there are pre-tax contributions. The employer may make matching contributions. They do not have to make matching contributions, but they may make matching contributions. Now, when an employer offers matching contributions, okay, if you pay in 5% of your salary, I'm going to give you 5%. But if you pay less than 5%, I'm not going to match you. Pay in 5%. Because you're giving up real money if you do not do that. I've talked to so many people that say, well, I really don't want to put 5% in my 401k. And I said, well, but your employer is going to give you 5% of your salary. That's a 5% raise, if you want to look at it that way, that you're going to get. If you take 5% of your salary and put it away, which is basically a wash, and that's 5% of money that you just leave on the table. I mean, you effectively leave that on the table. And it makes no sense. But in particular in situations where where you have an employer that for once is in some sort of government and or state retirement system, so you're paying to this and you're paying to Social Security, then people go, I do not want to pay into something else, and in addition to that, you're leaving money on the table. It makes no sense whatsoever. It might be an extra 5% or 7% or whatever it is, but you're also going to get an extra 5 or 7 or 10. Some employers, depending on who they are, and sometimes they have to make up. I work at a university, I work at a state university. If I were to work at a private university, you do not get the state retirement benefits. They have to make up for that, or they wouldn't be able to hire anybody. It's really that simple. They wouldn't be hired to hire anybody, so they make huge contributions or matching contributions to private retirement plans. They might give you 10, 12, 15% matching on an annual basis, because they have to make up for what the state retirement system pays. And that's, it's just a matter of being able to attract people to work for you. So, but they're also going to tell you, if you're going to do that for you, you're going to have to put some money aside as well. And if you don't do that, then you're going to get the benefit, and you leave that money on the table. And that could be a lot of money, it will be a lot of money over an entire working life. Don't want to do that. Now, sometimes what happens is that if your employer offers a 401k plan and they offer a matching, they're going to have to match every year. They cannot say, I'm only match you every other year or every 5 years. They're going to have to match every year. If they say, I'm not going to match anymore, then they can do that as well. They're not locked into this. There's a lot of companies, especially during the financial crisis, for example, that stopped the matching on the 401ks. But said, we're in a recession, we just can't afford to match your contributions. What then sparked a lot of people just stopping making contributions to a 401k plan altogether, which again makes no sense, because you're still saving tax deferred for your retirement. So even if your employer stops making matching contributions, that does not mean that you should stop making contributions. That is still money that's going to be used, because every dollar that you put in that 401k plan is your money. This is not like Social Security, where the rules might change or you're immediately vested in these programs. Now, you might have to work for an employer for a certain amount of years before they make matching contributions as well. Some employers say, I'm not going to make those matching contributions to you after a year or two. You have to work for me at least 3 or 4 or 5 years, and then I'm going to start making matching contributions. Or they might say, I'm going to match your contributions right away, but if you leave within 5 years, I'm going to take the match away, so I get to take it back. Now, there are all kinds of, you have to when you get a job and you look at these different, or when you have a look at and are changing plans or you're changing jobs, look at these different rules that they have. Every company has different rules. There's nothing standardized here. Every company has a different rule and does things differently. And you want to make sure that you know what's going on here. Now, the earnings accrue on a tax-deferred basis. Again, you don't have to pay taxes on the money that you put in, and you don't have to pay taxes on the investment income that is accumulated over time. However, once you start withdrawing from these accounts, when you start making qualified withdrawals, and you have to reach a certain age to be able to do that, 59.5 years, then you can make qualified withdrawals from your IRA account or from the 401k plan. We're still talking employers here. If you withdraw before that, they either might not allow you to withdraw, period, or you might have to pay a penalty. But if you start withdrawing, you're going to have to pay taxes on that. You're going to have to pay taxes on the money that you get out of this. If you don't want to pay taxes when you after retire, your employer might offer you a Roth 401k plan, which is the same thing. The only difference is that now your contributions are made post-tax. So the money that you put in the plan has already been taxed. So the government is not going to tax you again once you pull the money out. The question then is, and that's where also estate planning comes into, when am I going to pay more taxes? When is my income tax going to be higher? While I'm still working or when I'm retired? Because if I have a high tax rate now, then I want to make tax deferred and pre-tax contributions because I save a lot more. The more taxes I pay, the greater are going to be my savings if I do not have to pay taxes on something. The less taxes I pay, then any kind of tax savings doesn't do anything for me or very little. So it's basically a question of when do I think I'm going to pay more in taxes? Now or when I retire? If I think I'm going to pay more taxes when I retire, then I should do a Roth 401k. If I think my tax rate is clearly higher now, I should do a 401k. Now it's not necessarily as that simple. You're going to have to take into consideration how long you're going to contribute until you take money out and all of that. But it comes down to how much you expect to pay in taxes to pick between those two. A simplified employee pension plan is a more simple version that the IRS allows companies to set up in other than a 401k or Roth 401k plan. It's more easily administered, there's less cost to a company to do it, and they're more flexible in that they can make contributions or they can stop making contributions. The thing about this, only the employer makes contributions in that kind of plan. The employer makes contributions. You don't have to make any contributions. The employer is going to make contributions to your retirement. However, they do not have to do it on an annual basis. They can do it 1 year and then say, well, next year I can't afford it, so I'm not going to do it. And the year after I'm going to do it again, and so on and so forth. Doesn't matter how large the company is. The IRS allows that to be set up for companies of any size. This is normally something that small businesses do and self-employed. It's a very good system for self-employed people to set up. You can set up your own pension plan if you're self-employed. Where you can pull pre-tax out of this and all of that if you're self-employed. If you set up a simplified employee pension plan that includes yourself, if you have your own business that includes yourself in that. So that's what this is for. And again, that's when you talk to somebody who advises small businesses, those are the kind of pension plan that they recommend for small businesses because they are much cheaper to set up. And finally, we come to the individual retirement plans. And this is traditional IRA, which stands for individual retirement account, Roth IRA, spousal IRA, annuities. Now, traditional IRA, you invest pre-tax income up to an annual limit. The annual limit right now is $5,000 or $6,000 if you're over 50. It doesn't matter when you make that contribution. So in other words, if you have not put any money in your IRA account into since in all of 2011, for example, you haven't put any money in there, or you're not up to the limit yet, if you put it in there by April 15th, it counts for 2011 against your taxes. So if you have not made your full contribution to your IRA up to $5,000 based on against certain annual salaries, if you're single and you do not have a employee-sponsored retirement plan, there's no salary threshold. But if you are married and you make more than $183,000, you can actually not deduct the IRA contributions from your taxes. But again, that's adjusted gross income, so that's after you've taken all your deductions. So you're going to have to make a lot of money in order to fall into that category where you cannot deduct the IRA money from your taxes. And at that point, if you make that much money, a $5,000 deduction is not as big of a deal anymore and in terms of tax savings than if you actually fall into the situation where you can fully deduct it from your taxes. But you can do it by April. Actually, this year it's April 17th, because April 15th falls on a Sunday. April 16th is Patriots Day. The main IRS processing center sits in Massachusetts. It's closed on the 16th. So the Patriots Day they only have in Massachusetts. So that's when they have the Boston Marathon and the Red Sox have a day game in the morning. Then you know it's Patriots Day. When you live in the Northeast, you know that's Patriots Day. And but the IRS is closed, that processing office. So actually this year you have until April 17th to file your income taxes. So if you have not made contributions to your traditional IRA up to $5,000 or $6,000 if you're over 50, you can still do that. And it still counts towards your 2011 taxes. Even though we're already in April, it still counts towards your 2011 taxes. This is if you do not take it, it goes away. There are other retirement benefits, and that gets very technical, where you sum of the money that you can contribute, and particularly the employer-sponsored. If you do not get the maximum, there's a maximum amount of money that you can put aside into a 401k as well. You can actually roll that over. So let's say if the maximum that you could put away is $10,000, and when you put away $5,000 this year, you can actually put away $15,000 next year. That does not work for traditional IRAs. If you do not go up to $5,000 today to take the full $5,000 tax deduction that you can get, it's lost. You cannot roll it over. So it's a one and done deal. You do it or you lose it. You pay the taxes on withdrawals. They have to be qualified withdrawals. There are penalties. If you withdraw the money before, again, you're 59 and a half. You are allowed to withdraw money penalty-free, not tax-free. You don't have to pay taxes, income tax that is. On any money that you pull out of an account, you're going to have to pay income tax. If you pull it out for education expenses, when we talked about college savings a couple of weeks ago, you pull money out for education expenses, you do not have to pay a penalty. You pull out money to buy a home, you do not have a first home, not a second, third, fourth, fifth home, first home. You can, primary residence, you can pull money out of your IRA. Now, I personally do not necessarily recommend that, but you can, because of what you pull out today, you're not going to have in multiples when you actually retire. You might, think about other ways to, or maybe save a little bit longer before you buy that home. But you can do that. That's a qualified withdrawal. Anything that's not considered a qualified withdrawal, you're going to have to pay a penalty in addition to the taxes. Roth IRA contributions are not tax deductible. So you pull the money, in other words, you pull any kind of money that you already pay taxes on into that account. It's not tax deductible, so there is no maximum. You can pull as much money in there as you want to, because you don't get a tax benefit on that. That tax benefit on the traditional IRA is $5,000. You can put more in your IRA than that, but you only get the tax benefit for the $5,000. After that, it's taxed. Yes?
There is a section that requires you to withdraw distribution that is a 59.5. Is that on the traditional IRA?
I believe the required distributions are when you're 70. I think you can, when you're 59 and a half, you are required to start withdrawing from them when you're 70 and a half. That's when you're required. So you cannot just leave it there and have that, because at some point the IRS wants their money. That's basically the idea behind this. So at some point you can't just save and save and save and save and never touch it. At some point they want their taxes. So you're going to have to pull it up, but I believe it's 70 and a half as far as you are required to withdraw. You have to make withdrawals from it.
Then you have to pay taxes on it.
Yes, income tax.
Income
Yes, not capital gains. You don't have to pay any taxes on any kind of capital gains or anything that any investment income that you generated. If you started off, that first table that I showed you, and if all that money that accumulated over time, all the money that you earned on your returns, that is not taxable. That gains are not taxable. But if you pull $1,000 out of the account, you're going to have to pay taxes on that based on your personal income tax rate.
A percentage, don't they?
There might, and I'm not 100% sure, they might already give you the money after tax, so they might have already pulled something out, so they're making sure that you actually pay it, and then they give it back to you. But I'm not sure about that. I'm not 100% sure if you are being taxed directly by wherever you get the money from, that they just keep some of the money and pass it on to the IRS, and then you file your taxes, and if you overspend, they give it back to you, or if it is your sole responsibility to file for the taxes on the retirement amount that you made. I'm not 100% sure on that. And the problem is tax laws, they change every year. Every year it's something different. And every year there are different maximums and different minimums and different limits and this and that. That's why now there are CPAs and tax attorneys. They keep up with these things. If you're a CPA, you do have to keep up with these things. Otherwise, you lose your. You have to get recertified every year. But these things change. Just if you just buy tax software and you buy the tax software in, let's say, in December, every time you open up that program, there's some update that needs to be downloaded. Every time until you actually file the tax, because something changed again. And some rule was tweaked that whatever happened. Just like with the FICA tax, we didn't know until basically the end of December if we would be paying 6.2 or 4.2% in FICA tax starting January 1st, because Washington was a little slow on figuring out what they wanted to do. But we just didn't know until basically 2 weeks prior to when, payroll departments around the country were not very happy with that, because you actually have to set all this up, to make sure that you withdraw the right amount of money from people's paychecks. Also, you can establish a spousal IRA. So even if your spouse does not work or has very little income, where if you were to make less than $5,000, if you don't pay any taxes, your spouse doesn't pay any taxes, for example, you can still take a $5,000 tax deduction on the joint return for your spouse if you set up a spousal IRA. Now you can do that. So you establish and fund that on behalf of a spouse, and you can take that $5,000 deduction on your taxes for that. So those are the things that are available to you. Now, before I get to the annuities, because there's not much you can do there, but all of these 401k plans, IRAs, they might require you to make investment decisions. So this is where this all comes together with what we talked about before. These are just the vehicles where you're going to put the money. This is the actual place where it is, but now you're going to have to do something with it. In order to get that 5 or that 10% return on your investment, it doesn't happen automatically. There's something that you're going to have to do. Now, a lot of these programs, not so much the IRAs, but the employer plans, they are normally administered by some sort of investment company. For mine, for example, it's TIA Craft. That's the one that does it for all universities and schools and things like that. And they give you options. They say you can invest in this and this and this. They give you all kinds of different mutual funds that you can invest in. Or the newest thing that they do, and that most of these companies do, is life cycle options, where I say, okay, you think you're going to be working for another 40 years. We have a 40-year life cycle option for you. What that means is they have an investment plan where they invest your money in a mix of stocks and bonds based on what somebody should invest in when they still have 40 years left to work. And then that setup of that portfolio that they have is going to change every year. because that 40-year life cycle option that you invest in today is going to be a 39-year life cycle option next year, and a 38, 37, and so on and so forth. So they're going to continuously shift the investments in the portfolio the way they should be. The idea is, the closer you get to retirement, the less equity you should have in your portfolio. You know, you shift the risk from higher risk and higher return to lower risk and lower return the closer you get to retirement. And that's what these life cycle funds do for you. And basically you don't have to worry about anything. You want to make sure that they do things the way you like them to do it. You don't just want to sit back and say, okay, now let's see what happens 40 years from now. That's probably not a good idea. You want to see what they actually do. But it takes a lot of work away from you if you can trust them. And some of these companies have been doing these retirement planning for decades and decades and decades and didn't have any issues. Or again, they offer you a particular amount of, they give you certain options. Okay, you can invest, we give you an array of mutual funds that you can invest in. Some companies, and not so many do that anymore because it is not a very nice thing to do, require people to invest in their 401k money predominantly in company stock of that company. Most prominent example for that is Enron. Enron required to, I think, 90% of your 401k money had to be invested in Enron stock. That's why everybody who worked for Enron was wiped out when the company went bankrupt, because the stock wasn't worth anything and they were carrying 90% of their money in that stock. Again, not too many companies do that anymore. Some companies, especially large companies, they allow you to buy some of their stock for your 401k at a discount. Now, then you cannot sell for a while until it's vested and things like that. They will allow you to put that in your 401k plan up to a certain limit. There are limits on how much they can actually sell to you at a discount. And because that's another benefit that you get. That is fine, you can have company stock, but I mentioned at the very beginning, diversify. Having 90% of your money in one company's stock, that's not diversification. Now, in the case of Enron, they didn't have a choice. It was either that or no 401k. But again, companies gotten away from that because of that's the example that where people finally got to the realization that's probably not a good thing. But a lot of people feel very loyal to the companies that they work for, and that's great, and it should be. But the loyalty should not go to the point where you put all your money in that company stock, because that is not going to be very good for you. That happened. Especially people that work for large corporations like GE or GM and companies like that, they have a tendency to buy stock of that company in large numbers for their retirement. But if that stock doesn't perform well, you have a portfolio that doesn't perform. And yes, loyalty is nice, but loyalty doesn't feed you. And loyalty does not heat your home. That's the problem. And when you're retired, you can't live off loyalty. And you do need to live off the money in your retirement accounts, and you need to diversify. Now, some companies let you do whatever you want to. And obviously in your traditional Roth IRAs, this is you. You open an account with you can open it at your bank, you can open it with your brokerage firm, wherever you want to open it, and you put money in and you decide what you want to do with that money. They might give you some advice. That might be good or might not be so good, that depends. But you're on your own. And that's where it becomes important to understand, and that's why we had these previous sessions on mutual funds and bonds and stocks and all that, to understand, okay, what should I invest on? What are these different things that I can invest my money in? Because I'm going to have to make, for a lot of retirement plans, I'm going to have to make those decisions myself. Or I'm going to have to pay somebody to make those decisions for me if I don't feel comfortable about this. And that's where that's very important. Everything that I'm telling you here is just, okay, these are the vehicles that are available. But then you're going to have to come up with an investment strategy that makes sure that I'm actually going to have money in that account. Because the IRA accounts, the 401k plans, they don't guarantee anything. Right? The money is gone. If you lose all your money in that account because you're making bad investments, then guess what? You do not have a retirement account. A lot of people in the fall of 2008, retirement accounts lost about 30% of their value in 2008. 30% of value was gone in the fall of 2008 in retirement accounts. If you were to have to retire, if you were planning on retiring on January 1st, 2009, and you were planning on drawing from that account, you just took a 30% hit on your total wealth, and you might not have been able to do that. That unfortunately happens. This was something that we hadn't seen before like that, not since the Great Depression anyway. We haven't seen anything like that before. And again, if you were diversified outside of stocks, it would not have hit you as much. And obviously this is Mountain Brook, and in Mountain Brook, there's only one community in the entire country that lost more money in individual investment accounts than Mountain Brook. And I think that was Westchester, New York, right outside New York City. It was the only community in this country that lost more money in investment accounts than Mountain Brook per capita in the country in 2008. So it is first and foremost indicative of the wealth in that community, but that's just, nobody would have thought that, and I think most people who read that had no idea where Mountain Brook was. Most people are familiar with Westchester, New York, right outside New York City. That's where the Clintons live. Everybody is familiar with that. It's one of the richest communities. It's actually the richest community in the country. At least it was before 2008. But there's a lot of money being lost. Now, if you're more diversified, you can take this hit better. Now, you're still going to get hit. There's not much you can do. That's why also you should have different kind of investment plans and different things that you have set up. Now, by the way, I forget to mention that in the defined benefit plans, even if you have them from a company, the one thing that companies have to do, that they have to show, is benefit or pension liabilities. So if they take money from you, you're a large company, they take money from you for a defined benefit plan, meaning where they say, based on the years that you worked for us and the salary that you made, I'm going to pay you this amount of money when you retire. They're going to have created a liability on their balance sheet for that. Meaning, they can just say, well, sorry, we're out of money, I can't pay you. They cannot do that. They have to put that, and they have to fund that. And they're required to fund that. And some companies are required to fund that. The U.S. Postal Service is closing effectively, I don't know how many post offices they're going to close, but one of the reasons is because they got to find $2 billion to fund the retirement system. That's why they have to close. That's why they have to close because they're required by law to do that. There's a law that says you're going to have to be fully funded in retirement for this particular company. Other companies don't necessarily have to be fully funded. There's not a single state retirement plan that's fully funded. And as a matter of fact, the one in Alabama is one of the most underfunded in the country. I think it's funded about 60%. But they need to, other companies, private companies, they need to be fully funded. If they can't do it, then they have to stop taking money from employers and they have to stop these plans. That's what companies like GM did and GE did. They don't have these plans anymore because they couldn't afford carrying those liabilities with them. And the other thing is there's an insurance for these. The government is actually going to step in. If in the bankruptcy of GM or of any other company that has a defined benefit plan and goes bankrupt, the government, up to a certain amount per month, per beneficiary, has to actually pay. They are part of an insurance system. So these benefit plans, these retirement plans are actually insured. Now they do pay an insurance premium. It's not a free insurance, but these are actually insured to make sure that when the companies go bankrupt, that your money that you paid in there for years and years and years is not just lost. And so there are insurances for that. But again, most companies are getting away from this. Pretty much anybody is getting away. The state of Alabama just said anybody that they hire now is going to be subject to a very different rule when it comes to the retirement benefits than anybody who's been in the program so far. All these things are changing. The defined benefit programs in the long run are not affordable. And therefore, we're going to see some major changes in there. Finally, we got annuities. Insurance companies like to sell annuities. Now what you do is you contribute now in exchange for payments later. So you make payments over a certain period of time into this, and might be over the entire working life, and then they will say, okay, investment annuity, once you retire, once you reach this age, whatever age we set, by the way, in that annuity, whoever sells you that annuity contract, I'm going to make an annuity payment to you. So every month I'm going to pay you a certain amount of money. You have different options there that might give you a lump sum. So they say, I'm going to just give you a one-time payment today, and you're not going to see another amount of money. Or I'm going to pay you a certain amount of money over 20 years, over 30 years. Or I'm going to pay you a certain amount of money to you, but if you, while you're alive, but once you die, I'm going to stop paying, so your spouse is not going to get anything. There are all kinds of different options that are available to you. Depending on which option you pick, that determines how much money they actually pay out. Now, when you go for these annuities, and there's nothing wrong with these annuities, look at the cost. Some of these are really expensive, meaning that some insurance companies are going to charge like a 10% setup fee, meaning that you actually start with 10% in the hole, and you first have to work, you have to pay yourself out of the hole before you even get to zero, and then you start accumulating. Not everybody does that. Some of them are free. Some of them, then they have annual administration fees and all of these kind of things. Got to be very careful, because that's one of the, anybody who sells life insurances is going to sell you or trying to sell you one of those annuities. Again, there's inherently nothing wrong with annuities. It's a great system if you know what you want and you get a good return. They should tell you exactly what return you get in your investment. But what you need to be very careful about is the cost that come with these annuities. So when somebody is trying to interest you in an annuity, ask for the net return. After you take all the expenses out, what is the actual return on my investment? Because you might actually be better off just doing it yourself, putting it in a mutual fund, in terms of return on your investment. And then it's a matter of, you can calculate, okay, how much money can I take out of that mutual fund every month? If I assume that I live for another 40 years, how much money can I afford to take out of this mutual fund, assuming that I continue to earn the same return? I can calculate that. I don't need somebody else to do that for me if they charge me an arm and a leg for it. No, and that's what I have to be. A lot of times, again, this is convenient, that's easy, and that's great. But a lot of times we're getting charged a lot of money for that kind of convenience. And it pays to shop around, because not everybody does it. Just like when I talked about mutual funds a few weeks ago. There are mutual funds that's going to charge you a fee if you want to buy them, and there's some that are not. There's no reason to pick the ones that do, if there are some that do just as well without charging you. And the same is true for these annuities. There are annuities that are great, that have a great payoff going forward, have, obviously it's based on what the investment performance is, and based on how much money you put in. These contributions, by the way, are not tax deductible, so this is not an IRA or something like that. Now you could put an annuity into your IRA, which doesn't make sense. You can do that. People buy annuities in their IRA. The problem there is the contributions that you make are not tax deductible, which means that you have already taxed the money that you put in there. But if you go above the $5,000 per year in the IRA, it's the same thing. The investment gains made on an annuity are not taxable. So the investment gains, the capital gains, the return that you earn on the annuity is not taxable. What is taxable is when you get the distribution out of the annuity, again, you have to pay personal income tax on any distribution that you take. But the investment return is not being taxed, just the money that you take out. And that's not any different than an IRA. So it doesn't make any sense to put something in your IRA account that doesn't do anything different outside the IRA account. That's what that comes down to. So you can do that in addition or outside the IRA, because there are maximums for IRAs as well, and for contributions to other, I think it's like $17,000 or something like that for contributions in annuities and things like that. There is limits for all of these. When it comes to tax deferrals, there's a limit for everything. Nothing is limitless when it comes to tax deferrals. The IRS had a maximum amount for tax deferrals on anything. So if there is a tax deferred investment, if it is annuities, if it is IRAs, if it is 401ks, if it is a defined benefit, is anything that's tax deferred, there will be a limit on it. Because they don't want to lose too much taxes. They don't want the entire country to defer their taxes for the next 40 years. Because they do need the tax income. So there is an annual limit on how much of tax deferred contributions you can actually make. And you can go to the IRS website and you can find all of these. Or you can ask a tax return, you can ask the accountant that does your taxes if you have one. Or it is going to be in your tax software for that matter. Your tax software is going to answer all these questions for you too. Exactly what are the limits, because they change. And some of the limits are moving. Now, if you are between a certain salary range, then it's only 10% taxable, or 20% of it is tax deductible, or 40% is tax deductible. It gets all very complicated when it comes to taxes. Our tax system is fairly complicated in terms of where the limits are, what are the minimums, what are the maximums, what percentage is actually tax deductible, what percentage is not tax deductible. That's why a CPA can give you answers to all of these specific tax questions. But generally speaking, there is a limit. To anything that's tax deferred, there is a limit on how much you can put aside on a tax deferred basis. Now, there's not a limit on how much money you can put aside for retirement, obviously. You can save as much money as you want to every year. You just can't save it in an IRA, or you just can't save it in a 401k. You just save it in an investment account and buy a mutual fund. No, you can still use that for retirement, of course, but that's all fully taxable. Now, that's the difference between those. So there are maximums, and that's what we have to keep in mind. But the most important thing is that all of these require investments. All of these require investments, and we need to make sure that we know what we're investing for, how long we have to get where we want to get, and that the closer we get where we need to be, the less risk we're going to have to take. Your strategy should move from, if you are 20 years old, you should be you should invest in equities, and if you are retired, there should not be a lot of equities left in your portfolio. There should be income producing investments in your portfolio, because you cannot afford a major drop in the value of the portfolio at that time. If you're 20 years old and you have 45 years before you need that money, you can take a temporary drop in the market. You don't get worried about that, or it's not so much anyway. And then when 2008 happened, I looked at my retirement account and I had lost every single dollar that I had earned in investment income on that. So I basically was just down to what I had contributed. Luckily, I had not less than I had contributed. It hadn't gone down that far. But I had not any money left anymore in terms of investment income at that point. Now, it did not worry me too much. I wasn't happy about it, of course, but I didn't lose sleep over it, because now I have some more time for that to recover, and the money has recovered and then some since then, because the market has come back pretty strongly since 2008. So this does come back, and it's an upward trend. There are some bumps in the road when it comes to equities, but it's upward sloping. But the problem is, if you want to retire here, and the bump happens right before you're trying to retire, and you have all your money in the stock market, you have a problem. And that's why it's very important that you shift your portfolio more and more into less risky investments, the closer you come to the point where you have to rely on that money. The more you have to rely on that money, the less risky should the investment that you take. And that's the most important thing when it comes to saving for retirement. Apart from all these different options that you have, you've got to shift over time.
So diversified.
Diversify, but even the way you diversify changes over time. It changes over time between equity and bonds. Now within that, you still want to diversify. You also, then you have to decide, okay, when I'm 20, I want to have everything in stock. You still don't buy just the stock of one company. You still diversify within that asset class as well. But then over time, you're going to shift from 100% equity to 80% equity to 60 to 50 to 40 to 30 to 20 over time. And you still diversify within that class and diversify within your bonds. You don't put all your money in junk bonds. But you don't want to put all your money in treasuries either, because you're not going to earn a lot of return on those. There should be a healthy mix. But you are comfortable with the level of risk that you're comfortable with. That you don't lose sleep over that over time and wake up every morning thinking, I don't know if I'm going to afford, then I'll be able to pay my bills anymore next year based on my retirement. Yes?
Since we're looking for less risky investments, are any of these instruments FDIC insured? I know annuities are not, and I don't think mutual funds are.
IRA accounts are. IRA accounts are FDIC insured up to $250,000. Yes, if you open an IRA account at your bank, it is insured up to $250,000.
When that ends? I thought the end of this year.
No, they actually they made that permanent.
What?
Yeah, the $250,000 were made permanent. That's a permanent increase that came with that was part of the Dodd-Frank Act. It was in that one of the other one, the consumer, the one that created that new agency. That one, I forget, the Consumer Protection Act or whatever it's called, Financial Consumer Protection Act, whatever it's called, that actually established $250,000 at the maximum amount for the FDIC insured accounts.
Doesn't matter whether it's in the minority or bank or bank.
You gotta make sure that it might not be. The bank has FDIC insured. You gotta make sure that the IRA account that you open with Fidelity is FDIC insured. They will tell you that. It might not be. If you open it as an investment account with Fidelity, it might not be FDIC insured. Now it's SPIC insured, which is the Securities Insurance Corporation, but they only insure if the insured for your investment losses. So if your investment company goes bankrupt, you also are insured. The difference between those two insurance companies is that the FDIC pays you within a couple of days, whereas the Securities Protection Insurance Corporation, it might take years before you get your money back, because it's much more difficult for them to determine what you actually had in your account at the time when the loss happened. People that had money with Bear Stearns are still waiting for their money. Now, so there's certain things that take forever. FDIC pays within a couple of days. Now, at the same token, the FDIC never actually had to pay out to individuals. They don't do that because they just sell the bank off to somebody else, and they take over all of the deposits, and they take over the IRA accounts. But no, you have to make sure IRA accounts with your bank are going to be FDIC insured. Other IRA accounts might not be. You've got to make sure that you look it up, and it will tell you that if it's FDIC insured or not. If you open it with your bank, it's going to be FDIC insured. If it is not with a bank, if it's an investment account, it might not be. It depends. It depends the bank might say, okay, you give me your money in the IRA account. Now the IRA account that is actually FDIC insured is some sort of special account where you have limited options on what you can do with the money. So where you don't just pick what you want to pick of any investment, but this is some sort of plan. They might offer an annuity that's FDIC insured. But normally they don't do that so much. But the IRA accounts are up to $250,000 per person. So if you have an account, it's up to $250,000, If you have a joint account with somebody else, that counts as a second account, is up to 250,000. If you have a trust account on behalf of somebody else, that is another $250,000. So that already would account for 750,000. Then you can do the same thing at the next bank. This is not per person altogether, it's per person per bank. So you can basically get all of your IRA accounts insured if you just open them at different financial institutions, depending on how much money you have in them. Because obviously the moment you go exceeds $250,000, anything in excess of $250,000 would not be insured anymore in the event of a bankruptcy of that institution. But the IRA accounts that you get at your bank, they are FDIC insured.
This apply to IRA and the regular savings?
Yeah, and your regular checking accounts and all of these are all,
Are they separate?
yes,
The
yes,
IRA
yes. Your checking account is 250, your IRA account will be another 250, yes. Yes, it's per account per person. So, but it has to be a different kind of account. So you cannot have 5 checking accounts and each one would end up to be $250,000. Only one can be up to $250,000 in your name. Now, if you have 5 checking accounts across 5 banks, you have $250,000 in each bank. But you can have a checking account and an IRA account in the same bank, and each one of them is going to be insured at up to $250,000. Yes. And again, that's permanent now. Yes.
If you have a money invested in a 401k account and you're ready to retire, do you normally close that account and put that money in just a traditional IRA account? Is that?
You don't have to. You don't have. It depends on how that plan is administered from your, how your 401k. It might be that your employer is going to basically administer that. They hire somebody. They're normally not going to do that themselves. They're going to have somebody who does it for them, and that company is going to pay you out. So it's still going to stay in there, and it's basically, effectively what it is an IRA account with that in that particular company now, and they will pay you out whatever you withdraw.
I mean, the rules of an IRA and a 401k are the same. They
Yes.
start making withdrawals at the same age.
Yes, they are exactly the same. It's just there are 2 different things in that. One is employer based, and one is you can do the IRA in addition to. But the benefits on how much money you can actually deduct from your taxes depends on if your company has an employee, if you are part of a retirement system or not. If you are part of a retirement system, the annual maximum salary is much lower to take the full deduction than if you do not have a retirement system with your company. So there is a difference in the maximum annual and adjusted gross income that you can have in order to be able to take the full benefit. Yeah. Any other questions? Yes, sir.
Are you familiar with the Social Security spousal benefit? How that works?
Just to the fact that if a spouse dies, then whoever of the 2 had the higher benefits, those are the benefits that are continued to be paid. So that's why I said earlier, if the spouses have Social Security, the one that makes more money should be working longer, because the longer you work, and you can go you can actually run through all kinds of scenarios on that Social Security calculator that you can figure out, okay, if I make this amount of money, if I work to 67, I work to 70, what difference what benefit does it make in terms of the money that I get? And whoever gets more money out of this should be the one taking advantage of that, because when there is a death of one spouse, the other spouse is going to get the benefit of whoever had more. So you don't continue your own. If your one was less, you're going to get your husband's or your wife's benefit if that one was higher. That I know, but other than that, there's more specifics I do not know.
Well, my wife was approaching 65, and she had to do something to get her enrolled in Medicare.
Mm-hmm.
We're actually tracking all this occurred on the cell phone while underway. We got this nice shady person with Social Security. She asked her if she had applied for the spousal benefit. She didn't work long enough to earn her own benefit.
Oh, okay, yeah.
And to our surprise, she qualified. A month later, she began to receive her own benefit.
No, you are required, as far as Medicaid is concerned, yes, you're gonna,
No, this is from Social Security.
Social Security?
And you have to, there are conditions, you have to have been married a certain amount of time.
Okay, okay.
All that, she gets her own Social Security benefit in addition to mine, although she didn't work long enough to earn her benefit.
Well, I think the philosophical idea behind that is to not punish the stay-at-home moms.
I guess.
That's the idea. It's basically saying, if you're a stay-at-home mom, that doesn't mean you're not working. You just don't get paid. And that's the idea behind it. I know a lot of Social Security systems do that, not just the US, but around the world, where as a stay-at-home spouse, it doesn't matter if it's a stay-at-home mom or stay-at-home dad, you actually qualify because you stayed home and you did not work because of that. And that's, now, I don't know if the benefit that you then get, if you stayed at home because you had children to raise, or you stayed at home because you didn't want to go anywhere, you still get the same benefit, I assume. But the idea behind that is that, that you do not punish somebody who stayed at home to raise children, for example. And
We just weren't aware of it. I think she would have been eligible a couple of years earlier.
But yeah, so as far as Medicaid is concerned, you are eligible at 65, I believe, and then again for Social Security at 62 for reduced benefits and 67 if you were born after 1960 for full benefits. Any other questions? Okay, well, thank you. We have one more, our first Thursday in May, about fraud and record keeping. All right, thank you. And happy Easter.
Fraud and record keeping. Next month.